The hour of 10:15 having arrived, we will call the House Tax Committee to order. We do have a quorum, so we are good to go. Representative Elkins moves the minutes of February 24th, 2026.
I do, Mr. Chair.
And do we have any comments or corrections that need to be made?
Thank you.
Seeing none, all in favor say aye. Aye. Opposed? Motion prevails. Thank you, Representative Elkins. Okay, item next. We're very fortunate today to have House Research here that is going to be going over federal conformity, and we've got Fiscal. We have Fiscal here also, so we should be good to go. And then if we go too long, we might have to cut folks off and bring them back because we want to hear your whole presentation. And we've got folks here from the city of Blaine. We'll have the Norris bill, House File 387, and we'll have a hearing on that. And just so you know, that would be laid over for possible inclusion as we put the 2026 wonderful tax bill together. Okay, so with that, please state your name and who you represent for the record, please.
Chair Davidson, members, I'm Sean Williams, House Research. Mr. Clayman and I are going to be discussing conformity to Public Law 11921, the One Big Beautiful Bill Act. Our intention is to discuss a little bit about what tax conformity is, what it means for the tax committee, and then discuss the specific provisions of that law that are going to be sort of items of conformity that affect Minnesota's tax system. We're mostly going to describe how they work in our presentation, and then Ms. Templin, I believe, is going to go through the fiscal effects of those provisions after we're done.
Thank you, Mr. Williams.
Minnesota's tax system is sort of built on top of the federal system. Our individual income tax calculation starts with adjusted gross income. The corporate franchise tax starts with federal taxable income. That means any federal changes affecting either of those income definitions affect Minnesota tax liability. Most rules for calculating business net income affect AGI or FTI. Changes in federal rules don't automatically apply in Minnesota. We are what's called a static date conformity state. That means our tax system is currently tied to the Federal Internal Revenue Code as amended through May 1st, 2023. Because of the federal law changes last year, we're sort of tied to this old version that doesn't incorporate the changes in the One Big Beautiful Bill Act. This is sort of a diagram that explains the same concept, but it might be helpful if you're a visual learner. So this sort of just shows the blue boxes on this slide sort of represent the federal tax system. So it's the definition of gross income. You take adjustments to gross income and then get AGI, adjusted gross income. That's the starting point for our individual income tax. I might draw your attention to, on the left side of this diagram, sort of the Minnesota system separates from the federal system after adjusted gross income, which means that deductions that happen after AGI don't affect us directly through mechanical conformity. So if you look on the left side of this slide, for example, deductions for tips, overtime income, the senior deduction, and deductions for car loan interest all take place after the calculation of AGI. So those are not, by default, what we'll call mechanical conformity items, and I'll talk about that in a little bit more detail in a future slide. As a general rule, the reason that our system is built on the federal system is that it simplifies Minnesota's tax code, and conformity simplifies Minnesota's tax code. Starting with a federal income definition that taxpayers are already calculating, make it easier for taxpayers to file their returns. It reduces the cost of tax preparation, and it reduces the Department of Revenue's administrative costs because there's just simplicity built in. That simplicity, however, comes at a cost of less state control over the tax system. And so there are situations, and there's examples in current law, where we don't conform to federal rules. Nonconformity adds complexity to our tax code, and so you're sort of balancing the policy goals of simplicity with other tax policy principles like progressivity, competitiveness, and revenue sufficiency. So that's sort of the trade-off that you're thinking about when you're making conformity decisions. In the short term, there's complexity introduced to our tax code by not being in conformity with federal law. So the 2025 M1 NC, that's the non-conformity tax form, is 3 pages long and 43 lines. Some provisions also have multi-year effects. So, for example, businesses have to track separate depreciation schedules under federal and state law if we're not adopting the federal schedules. And that can last for many, many years because they might be depreciating property on one schedule over many years at the federal level and a different schedule at the state level. I'd also point out that many of our individual income tax provisions are phased out using adjusted gross income, which means that if you have a separate adjustment to gross income from due to nonconformity, you might have to separately calculate a different definition of Minnesota adjusted gross income just to phase out your Social Security subtraction or your child credit or another tax policy. I'd also point out that there's been a trend of growing complexity in Minnesota's tax code. So for this slide, we put together, since 2006, the different statute, the number of additions, subtractions, and itemized deductions in state statute over the last 20 years. So over the last 20 years, the number of these modifications to adjusted gross income for individuals has doubled from 29 to 58. Some of these are policy choices enacted by the legislature. Some of them reflect nonconformity, but sort of each new addition, subtraction, and deduction due to nonconformity will add complexity to our tax code. We're now going to move on to discussing sort of the individual provisions in this bill. We sort of group them thematically, so hopefully this structure makes sense. I'm going to talk about the education, childcare, and other significant individual provisions, as well as a few provisions that are not part of the sort of mechanical conformity, and I'll talk a little bit about what that means. And then my colleague, Mr. Clayman, will talk about the business provisions listed there. Relating to education, there's a provision in OBA that allows rollovers from 529 accounts to ABLE accounts. This was originally enacted in the TCJA, the Tax Cuts and Jobs Act of 2017. It was temporary, and the OBA law makes it permanent. So this would reduce revenues to conform, because without conformity, rollover distributions would be considered non-qualified distributions, and the investment earnings portion of the non-qualified distribution would be included in gross income. Section 70411 is a tax credit for scholarship granting organizations. This is essentially a 100% federal tax credit for up to $1,700 in contributions to scholarship granting organizations, or SGOs. These SGOs have to give scholarships for tuition and other educational expenses. There's some listed in that in the slide here. I'm not going to read it out loud. States also must elect whether or not they want to opt into the program and allow state SGOs to participate in the program. That election must be made by the governor or the entity designated in state law to make such decisions. So the effects on Minnesota, there's sort of three parts. There's a policy choice for the state about whether or not to participate in the program. Conformity actually to this provision raises revenues because there's a provision in federal law that disallows a charitable contribution deduction for amounts contributed to the SGOs, because essentially you're getting 100% tax credit for those contributions. So the federal government opted not to also allow you to make charitable contribution deductions for that. There's also a third provision in federal law related to these SGOs, which is that the scholarships are non-taxable to the families of the students that receive them. So conformity would make those scholarships non-taxable for Minnesota purposes. And I would say the second and third policy choices about whether or not we conform to the tax treatment is sort of independent of the choice about whether or not we actually participate in the program as a state. There's also a provision related to 529 accounts, that essentially allows, under the TCJA in 2017, up to $10,000 in distributions from 529 accounts was allowed to pay for qualified elementary and secondary school tuition. OBA increases that to $20,000, and it also allows distributions for other educational supplies, such as curricular materials, books, online education materials, and other items listed in that slide. I would note that there's no direct effect from mechanical conformity. Minnesota has a provision in state law opting out of the OBA provision that allowed the $10,000 for elementary and secondary tuition. And so that provision sort of means that if we don't make any other changes and we adopt the federal Internal Revenue Code, we're not going to pick up this provision, but it might be a policy choice for the committee to make. There's also a provision related to allowing 529 distributions for post-secondary credentialing expenses. And if we were to conform to that, it would reduce revenue. It's a portion of the distributions from 529 accounts that was used for those credentialing expenses would be taxable if we did not conform. Finally, related to education, there's a provision allowing employers to make up to $5,250 in employer student loan payments. And those payments would be non-taxable to the employee that receives them. This limit, under current law, that provision expired, or under old law, that provision was set to expire after 2025. It was enacted, I think, first in the CARES Act, actually, and it's been extended once since then. But this would make that provision permanent and then also index that limit for inflation. So conforming to it would reduce revenues. It would exclude these employer student loan payments from income if we conformed. I'm now going to talk about a couple provisions related to child care. The first relates to dependent care assistance. It's also commonly called dependent care flex spending accounts. Under old law, the amount of dependent care FSAs that was excluded from gross income was $5,000. And the OBA law, effective for 2026 and later, allows $7,500 for most taxpayers. So conforming to that would allow more income to be excluded from gross income and not subject to tax, so it would reduce revenue. OBA also includes a expansion of the dependent care credit. I have sort of the parameters written down there. I think it's actually, I have a graph that sort of makes this a little bit easier to follow visually. So the federal, under current law, Minnesota's dependent care credit is tied to the federal dependent care credit, but then we start to phase it out at an earlier point. So if you look at the dark green line on slide 12, that's the current law dependent care credit in Minnesota. The federal credit kind of continues and doesn't ever fully phase down to zero. Under OBA, the federal credit is expanded, so the credit rate starts at 50%. So you go from essentially a $2,100 maximum credit if you have 2 children to a $3,000 maximum credit if you have 2 children. And then it sort of phases down at the same rate as under old law. It just sort of starts at a higher percentage. So if you look at this graph, conforming sort of gives more credits to people that are already receiving them, and also because the phase out starts at a higher level, it sort of means that more people a little bit further up the income distribution also benefit from that credit if you were to conform.
Mr. Williams, would you like to have questions as we go or towards what do you say we go at the end?
Chair Davids, I'm happy either way, sort of as the committee would wish.
Okay, I think we'll let you finish yours and then we'll go to questions for you.
Very good.
Thank you, Mr. Williams.
So conforming to that expansion of the dependent care credit would reduce revenue. It's giving people more tax credits, sort of an expanding them. It's shown on that graph. The next section it actually relates more to employers and businesses, but I put it on this slide because it's another child care provision. So there's a provision, a federal tax credit for employer-provided child care. That tax credit is expanded under OBA, so it increases the maximum credit, and it also indexes it for inflation, and it allows credits for third-party intermediaries providing child care, and allows jointly owned facilities to participate in the federal child care credit. These expansions of the federal child care credit kind of counterintuitively, if we were to conform to them, it would reduce or raise revenue in Minnesota. The reason for that is there's a provision in federal law that's described as a denial of double benefit. So the federal government's giving employers under OBA a 50% tax credit for their employer-provided child care costs. But the law also specifies that they can't claim a business expense deduction for those same expenses because they're getting the tax credit for them. That change in the tax credit doesn't flow through to Minnesota because credits are calculated sort of after we've separated from the federal tax system. However, the denial of deduction does affect Minnesota, it does affect adjusted gross income or federal taxable income. So it's a denial of deduction that we pick up in Minnesota if we conform, and that denial of deduction raises revenue. There's a few other individual provisions I'll talk about briefly. The OBA law limits the charitable contribution deduction, the itemized deduction for charitable contributions to amounts deducted in excess of 5.5% of the contribution base. For most taxpayers, that would be adjusted gross income. And so essentially, you sort of subtract from your total charitable contributions. For most taxpayers, it would be 0.5% of their AGI. So it sort of restricts that charitable contribution itemized deduction. Our itemized deduction for charitable contributions is tied to federal law, so conforming to that would raise revenue. The next item is the limitation on the moving expense deduction. So the TCJA restricted, we used to have an above-the-line deduction for moving expenses that's essentially allowed taxpayers who moved for employment purposes to deduct their moving expenses related to that move. TCJA sort of restricted that deduction, only allowed it for members of the armed forces. That provision was temporary under TCJ. It expired in 2025, and OBA makes that restriction permanent. So basically conforming to that provision would raise revenue. It would limit that above-the-line deduction that affects AGI. The next provision relates to so-called Trump accounts. These are savings accounts established for individuals 18 and younger. You may have heard that there is a provision that also gives a $1,000 sort of payment to people who have children starting in 2025 through 2028. These accounts are sort of the vehicle through which the law enacts that. So these Trump accounts will have $1,000 started for individuals who have a child in last year or in the upcoming years. There's also a provision in federal law that allows up to $2,500 in employer contributions to be made to these accounts and have those not be included in gross income of the employee. So for Minnesota's purposes, The effect of conformity is reducing revenue, and it's just based on that employer contribution piece. So the employer contribution would not be taxable. There's also a provision related to transportation fringe benefits provided by employers. There was prior to TCJA, there was an exclusion from gross income for bicycle commuting reimbursement. That was suspended during TCJA temporarily. It was scheduled to come back onto the books in tax year 2026, and OBA made that suspension permanent. OBA also increased the limitation in federal law on transportation fringe benefits. And actually, conforming to this has sort of two offsetting revenue effects. We raise a little bit of revenue by eliminating that exclusion for bicycle commuting reimbursement expenses permanently, but then we reduce revenue because the threshold on total qualified transportation fringe goes up if we conform to OBA. So Chair Davids and members, that concludes my portion of this presentation. Maybe this is a good time to stop and take questions, and then my colleague, Mr. Clayman, will pick up on the rest.
Thank you, Mr. Williams. Representative Swazinski.
Thank you, Mr. Chair. And then Mr. Williams, kind of just talking, there was I think of the big, beautiful bill on the federal side, there's some action to be taken either from the legislature or the governorship for kind of educational freedom tax credits. Have you guys looked at that as an office and what the impact would be from a state financial standpoint if we were to take some action on that?
Mr. Williams.
Chair Swazinski, or Chair Davids and Representative Swazinski, the provision, Ms. Templin will sort of describe the revenue effects of conforming to that. I would say that the revenue effects for Minnesota are less related to our direct participation in that program. The costs of that program are essentially funded through this federal tax credit. So the effects on Minnesota primarily relate to whether or not we're going to tax the scholarships for the individuals who receive them, and then separately whether or not we allow people to make charitable contribution deductions for the amount they contribute to these scholarship granting organizations.
Chair Swazinski.
Thank you, Mr. Chair. So, you know, I've heard that too as well, that the question is whether or not, so if you receive that benefit of whatever that amount would be, $1,700 or more, if you were a student, more than likely low income, then that would potentially impact you. And so we do have a choice to do, one, participate, and two, look at the ramifications when it comes to individual income of those receiving it. So, as we're moving forward, Mr. Chair, I think this is probably an affordable way to make an impact on young people that could potentially use some choice when it comes to education.
Thank you. Questions for Mr. Williams, or we will go to Mr. Clayman. Questions for Mr. Williams? Okay, Mr. Clayman. I'm sorry,
Davids?
Mr. Williams.
I cut my presentation off a couple slides early, so my apologies for that. I have two brief ones.
Let's do those. And you don't have to be brief.
Very good. So you may hear staff use the term mechanical conformity. I think that this is just sort of a shorthand we use to describe what would happen if we updated that internal revenue date that I mentioned. This is May 1st, 2023. That sort of described the changes that would then automatically flow through to Minnesota. I guess I just point out that leaves out many provisions of OBA, including some of the more high-profile provisions in the law that have received a lot of attention. Many of those provisions don't directly affect adjusted gross income, or they modify parts of federal law that the state has sort of pre-opted out of, and so they're not part of mechanical conformity. So I want to just sort of discuss that term here to give you an idea of what we mean when we use it. So I'm not going to go through these in much detail, but I just wanted to include a slide on these just mentioning that the deductions for tip income, the deductions for overtime, the deductions for car loan interest, and the senior deduction of $6,000, these are not part of mechanical conformity. The legislature could still choose to offer sort of an equivalent deduction for state purposes, and my understanding is the Department of Revenue has shared publicly what the cost of those would be if the legislature chose to do that, but they're sort of not provisions that would automatically be included if we just sort of updated our internal revenue code date in state law. And with that, Chair Davids, I'm done with my part, and Mr. Clayman will pick up.
Thank you, Mr. Williams. Page 15, 70203, deduction for car loan interest establishes a temporary deduction for $10,000 certain car loan interest. The deduction beginning at $100,000/200,000. What is that $100,000, $200,000?
Chair Davids and members, that's a typo. It's meant to say that the phase out begins at $100,000 or $200,000. So it's $100,000 for unmarried taxpayers and $200,000 for married joint returns.
Okay, thank you. Okay, any other questions for Mr. Williams after he finishes his presentation? Okay, please state your name and who you represent for the record, please, sir.
Mr. Chair and members, I'm Chris Klayman with the House Research Department. We're going to move on in this presentation to those conformity provisions that, under a mechanical conformity scenario, would affect businesses directly or would indirectly affect businesses. There are a number of other provisions in OBA that do affect businesses, but because they don't affect Minnesota under a mechanical conformity scenario, we didn't include them in the slides, but we do have a much more thorough list of more of those provisions in OBA in the memo handout that's in your packet. So if any members have any questions about any of these other provisions, feel free to just ask and I can provide you with more background on that. The first set of provisions here affect capital gains, and these would be capital gains, the capital gains treatment for investors. The first one are changes to opportunity zones. Currently, under the previous version of the Internal Revenue Code, opportunity zones were a temporary program, and the OBBB makes that program permanent. In addition, it establishes new rules for qualified rural opportunity zones and makes a couple other modifications. Mechanical conformity to this provision would reduce revenue because it would extend those capital gains tax benefits past the current expiration date. Next are the provisions relating to preferential tax treatment for capital gains from the sale of qualified small business stock. And those provisions make some changes to the qualified small business stock program, increasing the cap on the amount of the gain that's excludable, and then also increasing the threshold for qualifying as a qualifying small business. And again, that would reduce revenue by excluding some of those gains from gross income in Minnesota and allowing larger businesses to qualify. There are a few provisions affecting losses in the OBBB. One of them is the extension of the limitation on excess business losses. This prevents non-business income over a certain amount from being deductible in the year that loss occurred. And that conforming to that would raise revenue in Minnesota by continuing to limit the extent that certain individuals can deduct those non-business or can offset their non-business income with net operating losses. Next is the limitation on wagering losses. Under the TCJA, wagering losses were limited. This affected professional gamblers who couldn't deduct business expenses other than their wagering losses. And so essentially, professional gamblers' losses were limited to their gambling losses, but not any of their business deductions for, say, traveling to a Texas Hold'em tournament or something. What the OBBB does is it limits the extent to which the gambling losses are deductible to 90% of the gambling winnings. That would raise revenue in the state by reducing the amount of those wagering losses. Moving on, there are a number of provisions in the OBBB that affect depreciation and expensing. At the outset, I just note that most of these depreciation and expensing provisions, they change the timing of when the nominal amount of these deductions is claimed. And so you'll see notes that say it raises revenue or reduces revenue. A lot of times, if you went out many years, you would see some balancing on this, but, so these are really timing changes. And of course, when you accelerate the timing of a depreciation deduction, you increase the present value of that deduction for a taxpayer. In addition, there could be taxpayers who, if you extended the timing of that deduction for many years, they might go out of business and wouldn't be able to use it. So the first one are the changes to bonus depreciation. OBBB makes the bonus depreciation deduction permanent at 100% of the basis of the acquired property. Currently, bonus depreciation will expire, and the percentage deduction is, I believe, for tax year 2026 is only 20%. There are some interesting effects on conformity when this happens, because Minnesota creates a 5-year add back for all bonus depreciation amounts deducted federally. And so that has an interesting effect where some of the 3-year property that qualifies for bonus federally then actually turns into 5-year property at the state level. So you do see an initial revenue increase because of that effect. The next section is the provision allowing full expensing for experimental and research expenditures. This is a deduction for R&D amortization, it's sometimes called. Currently, it's 5 years for domestic R&D, and the OBBB allows full expensing of those research expenditures. And that'll reduce revenue in Minnesota by accelerating the timing of that deduction here under mechanical conformity. OBA also expanded Section 179 expensing by increasing the total amount that can be deducted under that provision, and also by increasing the phase-out threshold where it phases out dollar for dollar after that phase-out is hit, and that's the amount of the investment which is used to determine that phase-out. Again, that would reduce revenue in Minnesota. There's also a new federal expensing provision for qualified production property. This applies to non-residential real estate. It's similar to bonus depreciation, and it would be non-residential property that's used in manufacturing, production, or refining. And there should be a comma after manufacturing in the slide, so if that was confusing to anyone. Again, that would also allow accelerated depreciation in the state. There's also a provision for expanding the expensing under federal law for certain film, television, and theater productions to exclude certain sound recording productions. Those are defined by federal law. There's also a bonus depreciation provision for those sound recordings as well. A slight difference in the timing of when those expenses can be expensed under both of those provisions. Again, that would reduce revenue in Minnesota under conformity. Lastly, the OBBB terminates an accelerated depreciation provision for certain wind and solar properties. This is electrical generation utility property. And so under conformity, the time period over which that deduction can be claimed would be extended from 5 years to more years. That would raise revenue because it's a deceleration of that deduction. There are also some changes in OBA to international taxation. This is relevant to Minnesota and would affect Minnesota under mechanical conformity because Minnesota conforms to both GILTI and Subpart F income. So those are two pieces of international income that are currently taxed in Minnesota, and they're taxed as dividends in Minnesota. The first change is to the GILTI provisions. It stands for Global Intangible Low Taxed Income. Under OBBB, that the name of that has changed to NCTI, or Net CFC Tested Income. And that's because Congress has decided that they don't want to try to target a deemed intangible return anymore from GILTI. And the way that Congress did this in OBA was by eliminating a deduction for certain amounts that were deemed to not be intangible income. And so without that deduction, the amount of GILTI now NICTI would increase. And so by increasing the tax base, conformity would raise revenue in Minnesota on that provision. OBA also modified certain rules for determining what foreign corporations are defined as controlled foreign corporations. That's a specific designation under federal law. Controlled foreign corporations are part of the calculation of GILTI and Subpart F income, which is another kind of international income. And so conformity to those CFC rule changes would have offsetting revenue effects. One of them would increase the number of CFCs that qualify, and one of them would decrease the number of CFCs that qualify as CFCs from current law. There's also a provision that would permanently extend what's called the look-through rule. This relates to Subpart F income, and it excludes non-US business income from Subpart F income under certain circumstances. It was a temporary provision. It's now made permanent. And the conventional wisdom on this provision is that the look-through rule allows the reinvestment of certain foreign earnings abroad without incurring any Subpart F liability. So that would, again, reduce revenue from the baseline assumption by reducing the amount of Subpart F income that's taxed in Minnesota. There's another provision relating to the tax year that certain foreign corporations have to use. Federal law used to allow certain foreign corporations to use a tax year that was a year earlier than the primary US shareholder, and that's been eliminated. So to the extent that allowed certain tax planning opportunities for foreign corporations to defer recognition of certain income by using a different tax year, that would raise revenue on a one-time basis in Minnesota through conformity. There are also changes to the business interest deduction. Under current law, business interest is limited to 30% of what's called adjusted taxable income. And the way that adjusted taxable income is calculated is based on a corporation's earnings before interest, taxes, earnings before interest and taxes. And what OBA does is it goes back to the original way this was calculated by requiring adjusted taxable income to be determined on a calculation which looks at earnings before interest, taxes, depreciation, and amortization. So the upshot is that under the EBITDA calculation, you have a broader tax base for determining adjustable taxable income. And so the percentage limit, the 30% percentage limit, then would increase because you're using a larger base to determine what it is. And OBA also expanded certain floor plan financing interest from the exclusion here. I would also point out on this slide that the words EBITDA and EBIT, the two acronyms, those are reversed, so they should be switched in the slide.
I was going to mention that.
Embarrassing.
Again, that would reduce revenue in Minnesota by increasing the amount of the deduction under the expanded percentage cap. The last few slides are miscellaneous provisions that didn't fit into any defined category. I'll go through these, I guess, somewhat more briefly. The first one is that there is a new 1% floor for the charitable deductibility of charitable contributions by corporations of 1%. There's also an exception to the denial of the business deduction for certain employer-provided meals. This would be for meals that are prepared and sold by the employer, and then also 50% deduction would be allowed for meals provided on fishing vessels. OBBB also provides an exclusion for 25% of the interest received by a lender on loans that are secured by agricultural real property. So if the first 25% of that interest income to the lender would be deductible. OBBA also terminated the energy efficient building deduction, which allowed the deductibility of a certain portion of energy savings improvements. That one would raise revenue in Minnesota because it's, if under mechanical conformity, because it's eliminating that deduction. There's a provision related to when the income of residential real estate developers is recognized or reported for purposes of paying income tax on it. Under the old law, a completed construction accounting method could be used to do that rather than a percentage completion. This meant that the income from certain residential construction contracts could be, a developer could defer the timing of when they had to report and pay tax on that income, but that was only available for construction contracts for 1 to 4 unit properties, and OBBB expands that to all residential construction contracts. That also has a temporary effect in the state through conformity because of the, well, I wouldn't say temporary, I guess, but that'll delay the timing of when certain income is recognized in the state. There are some provisions related to changing some of the tests used for real estate investment trusts or REITs. The effect of those provisions would be a revenue reduction in Minnesota. This has to do with something called the subsidiary asset test, and REITs would have to, the test is actually a little bit looser, and so as a result, one of the outcomes of that is that there could be fewer disqualifying rents for REITs, disqualifying rents for purposes of the dividend pay deduction that REITs get. That's one of the tax advantages of that particular type of investment. There were also changes to the excessive remuneration provisions under federal law. There's a $1 million limit on the deduction for compensation paid to certain covered employees, so very highly compensated employees of a corporation. Essentially, that's spread out to a broader range of businesses. It goes from an affiliated group to a controlled group. And that also raises revenue because of that dilution effect under mechanical conformity. Lastly, I did include one slide. I did include one slide that has some business provisions that don't have an impact under mechanical conformity. I guess the first one here is the modification of the qualified business income deduction. That was made permanent. And that does have potentially an effect on some of the REITs as well, because the REITs can take that, the investors. I think the most important one I'd just call attention to here is the increase in the SALT cap to $40,000, so it used to be $10,000. That doesn't have an impact in Minnesota, but conformity would revive the state's current pass-through entity tax, which is currently expired. So conformity would allow pass-through businesses that elect to file and pay the pass-through entity tax to continue to do that, and because the the salt cap still exists under federal law in modified form. Conformity would, again, revive that particular provision. And Mr. Chair and members, that's the end of the business provisions that we have in our slides.
Thank you. We'll go to member questions now. But first of all, Mr. Clayman, I think the one on page 24, that's the one that everybody's getting contacted by their CPAs and their small businesses and all that, I believe.
Mr. Chair, I believe you're referring to the salt cap provision.
Correct, Mr. Clayman.
Yes, so that's currently expired in Minnesota, and so the state's pass-through entity tax allows pass-through businesses to elect to file and pay that tax, and what that does, it doesn't have it's not intended to have a revenue impact in Minnesota, but what it does do is it allows for those pass-through businesses to claim a higher federal deduction for the individual income tax that they pay on their business income. That's can be a pretty valuable benefit for certain pass-through businesses.
Thank you, and I believe next week we're going to have committee time on that issue. In particular, on page 23, 70439, restoration of a subsidiary asset test for REITs. Subsidiaries may represent 25% of the REIT's assets. What is a subsidiary for a REIT?
Mr. Chair, a REIT can have, I believe, an ownership stake in a taxable REIT subsidiary that provides certain services. The upshot of this and the details on this are I'm not completely clear on, so I won't pretend to be an expert. But the upshot is that for some of the income received by those subsidiary REITs, because it's not rental income or real estate derived income, it could disqualify a certain amount of the rents for certain projects from qualifying for the dividends paid deduction that these REITs get. You know, the REITs are essentially like pass-through businesses, so they can take a deduction for the dividends that they pay. It's unlike, say, a corporation, a C corporation that can't do that. Okay. And I can provide more detail on that if you'd like.
Thank you, Mr. Clayman. Representative Anderson.
Thank you, Mr. Chair. I have a question on the past one. So I was looking at the spreadsheets. My understanding is this raises conforming or reinstating the expired PTE actually raises revenue for the state. No. Because people are paying at that higher rate, 100%. Is that correct?
Mr. Clayman.
No? Mr. Chair, Representative Anderson, no. So the way that the pass-through entity tax works is that the pass-through businesses, they can elect to file and pay the pass-through entity tax, but then state law gives them a 100% credit for the tax that they paid. So it's intended to be revenue neutral at the state level. And then those individual pass-through owners would file and pay the tax on that business income as usual on their state income tax form. So it's in some ways the pass-through entity tax taxes the income twice, but then they get a credit for one piece of that.
Okay, thank you.
Yeah.
Representative Anderson.
Oh, that's.
Any other questions from members? Otherwise, we'll go to House Fiscal, and then we will go to the Norris bill. Okay. House Fiscal. Oh, any other questions for Mr. Clayman and Mr. Williams? Thank you, gentlemen.
Good morning, Mr. Chair. My name is Cynthia Templin. I'm from the Nonpartisan House Fiscal Analysis Department. We just heard a summary of the federal conformity provisions from my colleagues in House Research. And next, to build on this conversation, I want to give you a big picture understanding of the estimated fiscal impacts of these provisions. You should have two fiscal documents. One document you should have is the revenue estimate from the Department of Revenue and the fiscal spreadsheet on legal size paper. In this presentation, I'll be working off the House fiscal spreadsheet. This spreadsheet is based on the DOR revenue estimate for federal conformity, or mechanical conformity, and it shows, the spreadsheet shows the same information as the revenue estimate, except the spreadsheet filters these mechanical conformity provisions and their fiscal impacts into 7 categories. Rather than going line by line on the spreadsheet of the fiscal impact, I want to highlight a few federal conformity provisions within each category and the subtotal for each group. Some of the provisions on the spreadsheet may fit into more than one category, but in a perfect world, it would only fit into one category, but sometimes a provision may, be applicable in different categories, but I did my best there. So one more thing I want to mention too is that the fiscal impact in the spreadsheet shows the biennial fiscal impact to the general fund and only to the general fund. If you see a provision listed twice, it is because it affects 2 tax types. And one other housekeeping thing I should mention is that a provision in parentheses means it's a revenue reduction or a cost to the general fund. If it doesn't have parentheses, it's an estimated revenue gain to the general fund. Moving on. And one other thing I wanted to note. The spreadsheet also includes the OBBA section for each provision, the section number. And so if you would like, you can crosswalk that section number to the numbers that were presented in the presentation from House Research today. So jumping into the contents of the spreadsheet, we're going to jump around a little bit, and I want to bring your attention to page 2, line 59 of the spreadsheet. And this shows that if every provision in mechanical conformity was adopted, the estimated general fund fiscal impact would be a revenue reduction of $387.99 million in the fiscal 26-27 biennium, and an estimated revenue gain of $89.82 million in the planning years. So by category, you can see the groupings of these mechanical tax provisions that have a net cost or net gain. The category with the highest net cost or revenue reduction are categories that have a lot of provisions with retroactive effective dates. 2 federal conformity categories that have the highest cost are the business extenders. The business extenders are listed on lines 21 through 33. And the subtotal for these provisions is an estimated general fund reduction of $373.560 million in fiscal 26 and 27, and a revenue reduction of $2.6 million in the tails. Some of the business extenders that I want to highlight, one of the biggest provisions is, let's see, on lines 25 and 26, the domestic research and experimental expenditures. The sum of these 2 lines, this affects 2 tax types. This has a revenue reduction of $349.1 million in 26 and 27, and $21.1 million in the tails. And this is the expensing and amortization provision. And a lot of, you can see for a lot of these expensing provisions, most of the cost is in the first biennium, and that's because when you place a property in service and you you accelerate the deduction, the impact to the general fund is highest in the first biennium for many of these expensing provisions. A few other expensing provisions that I want to highlight are Section 179 expensing on lines 27 and 28. The sum of those two lines has a revenue reduction of $36.2 million in the 26-27 biennium and $22.7 million in the tails. As my colleague Mr. Clayman mentioned, many of these expensing estimates will net to zero over time. Some of these, you see the cost, their cost in the current biennium may turn to revenue gains outside of the budget forecast window. But we're not able to get estimates for when these estimates turn either positive or negative outside the forecast window at this time. So. Another category that I thought I would highlight that has high general fund cost relative to other provisions is the miscellaneous business provisions. And that is on page 2, lines 40 through 58. Again, many of these miscellaneous business provisions have retroactive effective dates. You can see the subtotal for these provisions on line 58 is a revenue reduction of $153.3 million in the fiscal 26-27 biennium and $192.3 million in the tails. One of the provisions I thought I would highlight is on line 45 and 46, and these are the opportunity zones. The total revenue impact of this provision to the two tax types is a revenue reduction of $47 million in the first biennium and $173.4 million in the second biennium. So then, turning to the other side, or the other end of the spectrum, there are also federal conformity provisions that that are estimated to increase general fund revenue. The federal tax conformity provisions that increase the most revenue are in the child and dependent care expenses category. That is on page 1, line 5, the subtotal in that category is a revenue gain of $111 million in the 26-27 biennium and $196.7 million in the tails. Most of that revenue gain is on line 3 and 4, and that is for the enhancement of the employer-provided child care credit. And as my colleague, Mr. Williams, mentioned, there's a revenue gain because of the disallowance of the denial of the double benefit. It provides a credit. And so you can't get the deduction at the state level, and so that is why there is a revenue gain for that provision. Another category where there is there is some revenue gain is in the international business area or category, and that is on lines 34 through 39. And one of the largest revenue raisers in that category is the GILTI modification to net CSC tested income. On line 37, that shows there's a 3.9 revenue gain in the first biennium and 9.3 million in the second biennium. And then also there's a revenue gain in the charitable contributions section of the spreadsheet, lines 18 through 20. The revenue gain is 19.9 million in the first biennium and 64.8 in the tails. And the only other categories I haven't mentioned yet are the educational expenses category. That is a mix of revenue raisers and revenue reductions, and you can see the subtotal on line 10. And then the miscellaneous individual category, there are a mix, again, of revenue raisers and a revenue reduction tax provisions, and that increases revenue by 8.7 million in the first biennium and raises an additional 22.1 million in the tails. So That is a quick, high-level, big-picture overview of kind of the mechanical conformity provisions. Again, just closing this discussion about mechanical conformity. Again, the cost is estimated by the Department of Revenue to be $387.990 million in the first biennium and a revenue gain of $89.820 in the second biennium. On the third page of that spreadsheet, there is, I have also summed up the Department of Revenue's estimates for other federal conformity provisions. And I won't go through each one line by line because you can do that. But if you summed up all of these other provisions, and if they were enacted as a state deduction, the estimated cost would be $1,020,400,000 in the first biennium and $1,090,800,000 in the second biennium. Thank you, Mr. Chair. That concludes my presentation. If you have any questions, please let me know.
I was just thinking it makes a big difference if you have to balance your budget or if you don't.
Turns out.
Okay, Representative Johnson, then we're going to go to Gomez, then we're going to go to Representative Norris's bill unless you've got questions here. And members, please feel free to call House Research, House Fiscal. They are like awesome to work with, and they will walk you through some of this, some questions you may have. Representative Johnson.
Thank you, Mr. Chair. Thank you for the presentation. I just have one question when we're going through in the business extenders on 25 and 26 regarding the R&E. And you said it's higher because of kind of, it looks like retro one time, but my question is, with the bill, was it a one-time credit, so it's not an ongoing credit for R&E? As far as, so if there's continual spending of it, why wouldn't that affect going forward? Does that make sense?
Ms. Templin or?
Mr. Chair and Representative Johnson, just, I'll give you what I know. It's that is a permanent expensing provision. And a lot of the costs that you see in the first biennium is because that is a retroactive provision that affects small businesses. And that goes back to tax year 25. This is different from what was enacted in Chapter 13 in the tax bill last session. And that was an R&D tax credit that had a capped amount. If I'm understanding your question correctly.
You are, I guess I'm just, the drastic, sorry, Mr. Chair, the drastic change from 1 year biennium to the next, this assumes like, yes, it retros back to 25, but if it is an ongoing thing, we expect that there'd be ongoing expenditures with that. I'm just trying to understand a little there.
Mr. Clayman?
Mr. Chair and Representative Johnson, yeah, I neglected to mention in my presentation that there are 3 components to the federal changes to R&E expensing. There's a retroactive provision for small businesses that goes back to tax year 2023. And then there's another provision that allows, right now it's a 5-year amortization schedule. There's an acceleration provision for investments after tax year 2022 that allows taxpayers who are already in the middle of that 5-year schedule to accelerate the timing of when they take the remaining part of that deduction. They can choose 1 or 2 years. And so that's part of what front loads this.
Okay.
Then there's a forward-looking provision that provides expensing for all investments from now into the future, and that's the permanent provision. So it's a little front-loaded at the beginning because of those first 2 provisions.
Okay.
Representative Johnson?
Thank you, Mr. Chair. Thank you.
Any other questions? Representative Freiberg?
Thank you, Mr. Chair. I know when Mr. Clayman was presenting, we were talking about the pass-through entity provision. Is that reflected in this spreadsheet that we received?
Ms. Templin?
Mr. Chair, Representative Freiberg, it's on page 3. There is, if there is a cost for conforming to the assault changes in OBBBA if Minnesota creates a standalone deduction. But other than that, there's not a cost on the spreadsheet to mechanical conformity because the provision in Minnesota expired.
Chair Freiberg,
Okay, thanks. I think that,
any other questions? Okay, so we'll move on here. We want to get the, yes. Just a couple of things here. We will be talking a lot more about conformity. It's my goal to do as much as we can, but I think if you look at the numbers, that's going to be a little tricky. So we will continue to work on this. We'll continue to work on the PT pass-through entities. And I just want you to know that Chair Gomez, I think there's another chair in here. Chair Lincheski and I would always try to get conformity done as soon as we could because it helps the accountants, it helps your constituents, it helps everybody. This is a bit of a monster that we're looking at here, so we are going to be spending some time on it, and I hopefully we can do as much as we can. But Chair Gomez holds the world record for conformity. It was once held by Chair Lincheski, then it was held by me, and most recently she beat me by a day, and that really bothers me. But there's not a lot I can do about it this year because we're going to be talking about conformity for a very long time. Chair Gomez.
I suspect you're right, Mr. Chair. Thank you. Happy to be the world champion. So I think I really appreciate this discussion today. As the chair said, I mean, this is one of, kind of the biggest tax issue that we're going to be facing this year is conversation about, how it is within our system that we react to these changes at the federal level. I think that like in taxes, sometimes we isolate ourselves from other areas of policy. And, in these conversations about like RITs and amortization schedules and extenders and opportunity zones, like we can get a little bit remote from what we're actually talking about here. And I just think it's very important for us as we are having these really critical discussions moving forward to keep in mind what this bill at the federal level did. It added $4.1 trillion to the federal deficit over the next 10 years that our kids and grandkids are going to be dealing with. It completely gutted medical and food support for low-income Americans. It's going to kick tens of millions of people off of their critical health care. It truly chooses winners and losers. And this will come as a shock to absolutely nobody, right? Who are the winners that were chosen by this bill? The ultra-wealthy, billionaires, big corporations, people who have been benefiting handsomely, richly from the inequities that exist in our system and that have just accelerated year after year after year. It gets worse and worse and worse. The rich get richer and richer and the poor get poorer and poorer. And who are the losers? Medicaid recipients, mostly kids. SNAP recipients, mostly kids. Small business owners and farmers who rely on getting their insurance from the exchange, some of whom have seen their premiums double and triple. Our counties, right? Adding this level of complication to Medicaid and SNAP benefits when we delegate that responsibility entirely to counties means that we're passing tens of millions or hundreds of millions of dollars of cost onto counties. And what does that mean? Because as we all know, as people in the tax committee, we really restrict our local government's abilities to independently raise money. Because we know that in order to have everybody in our state have an equal shot at a good life, we have to equalize, we have to make it so that a kid's proximity to tax base, whether income, sales, or property, doesn't, dictate their chance of getting a good education or having access to good amenities. And so that means that the cost of this, because it's going to be borne by counties and our hospitals across the state that are going to have to absorb the costs of, people who show up at their doorstep and don't have medical care because they've been kicked off Medicaid or because they can't afford their premiums on the exchange. That goes back to property taxpayers. And as we all know, as people who go out and talk to hundreds of people every couple years, thousands of people, if you're Representative Norris, that is a huge concern across our state, regardless of what your politics are. And so, as we're making these decisions about amortization schedules and REITs and opportunity zones, it's like we have to think about what we're doing to our local governments, what we're doing to our property taxpayers, what we're doing to our kids who rely on Medicaid in order to go to the doctor, and what are the costs of that to the state. And so, we're going to be looking really carefully at this, but I'm just going to insist that we keep it contextualized and that we don't lose sight of what this really is, which is this giant transfer of wealth from the poorest in our country to the richest in our country. Thank you, Mr. Chair.
And thank you, Chair Gomez. Okay, now we are going, and we're going to be talking a lot more about conformity, and I appreciate your points, Chair Gomez, and fiscal, but like I said, if you do have questions, if you got questions, ask me. If you have tough ones, please ask House Research and Fiscal. That'd be to everyone's benefit. Okay, we have now before us, Chair Norris is going to move House File 387, and we're very happy today to have former member Tim Sanders here and Jason Zimmerman, Finance Director, City of Blaine. Two-year bill, so Representative Norris moves his bill, and it will be laid over for possible inclusion. We're not going to vote on it, but just so we have it before us, Representative Norris, two-year bill.
Great. Thank you, Chair Davids. I am bringing this bill forward today on behalf of the City of Blaine. Blaine is home to an important state asset, the National Sports Center. It's actually the second biggest tourist attraction in the state of Minnesota. And the National Sports Center and its surrounding commercial area really have kind of a symbiotic relationship. The commercial district thrives because of the proximity to the National Sports Center, but increasingly the National Sports Center, which is a state-owned facility, depends on the area around it to remain competitive as well. It used to be that the National Sports Center was the only game in town across the country, but increasingly these facilities have sprouted up across the country, and when you're competing for tournaments, one of the things that tournament organizers look at is things like proximity to hotels, proximity to restaurants. What are the entertainment options around the area when folks have time to kill in between games? So to help the Sports Center remain competitive and to help keep more of the tournament revenue in Blaine, the city established the 105th redevelopment area. It's a large mixed-use development that will include entertainment venues, restaurants, lodging, retail, and apartments. To aid the project costs, the city is requesting the option to impose a variety of special local sales taxes that have been used for other large regional attractions throughout the state. Importantly, the City Council would have to vote to implement these taxes by ordinance once they receive permission from the legislature. But given the tourist focus of this redevelopment and the area surrounding the National Sports Center, it makes sense for us to utilize taxes that would be predominantly paid by the visitors who frequent that area. And with that, Chair Davids, I will turn it over to my testifiers.
Thank you, Chair Norris. Would the Honorable Tim Sanders like to go first?
Thank you, Mr. Chair.
You have the
Chair
floor.
Davids, thank you very much. Chair Gomez, thank you very much for the time today. Members of the committee, really appreciate your time and consideration on this. And Representative Norris, thank you so much for authoring this bill in the House, and great job outlining what our needs are in this bill here today. Just to echo what Representative Norris said, the City of Blaine is seeking the authority to establish a special taxing district. It's geographically defined and confined. to further our robust entertainment and amenity-driven district in the heart of our city. Blaine is a rapidly growing community. It's a wonderful community. But Blaine is also host to the #2 reliever airport in the state with the Blaine-Anoka County Airport, and the Minnesota Amateur Sports Commission and the National Sports Center, as Representative Norris stated. Both those state facilities have about 1,400 acres right in the middle of our city. The special district was geographically chosen in 2021 because, number one, it was an industrial zone previous to this with many blighted buildings, many of them built in the 1960s, which no longer really met the needs of the city as we continue to grow and develop. And number two, again, it's immediate proximity to the National Sports Center. National Sports Center has 4 to 5 million visitors every single year. They are the host community to the USA Cup, and one of my favorite things, what I'm most proud of during that tournament, its slogan is really where the world comes to play. Many people from all over the world, I think we had 38 different or 40 countries last year, come to the state of Minnesota, to Blaine, to participate in the USA Cup. Truly an amazing unifying tournament that lasts about 10 days. We also have the Special Olympics this summer, which will be hosting several events for the Special Olympics in the city of Blaine at the National Sports Center. Having a world-class, amenity-driven district is paramount for keeping the National Sports Center viable and a highly desirable destination, and gives our residents a heart of the city. Blaine is a sports and recreation community. This project has developed significantly. The horizontal construction was completed last year. We break ground this spring on vertical construction, but a lot has come together since this bill was introduced last year. So we're looking forward to continue to work on this bill with the chairs, members of this committee, the authors in both bodies. We're also looking at a special sales tax for this district, as well as looking at extending the abatement period from 20 years to conform with the bonds that we're using inside of the district. So again, here today, we're seeking permission and authority to establish this special taxing district, again, geographically confined and defined, and many of the uses are outlined in the bill before you. Again, as you stated, Mr. Chair, I have Jason Zimmerman, our Director of Finance for the City of Blaine, with us here today. Greatly appreciate all of your time and happy to answer any questions that you all may have.
Okay, and we will open up for questions, or we'll go to Mr. Zimmerman, the Finance Director, City of Blaine, first for comments. Or are you a resource?
Chair Davids, I'm a resource this morning and happy to answer any questions that the committee may have.
Okay, wonderful. Thanks for being here. I just want to make sure you get paid your mileage. I'm big into mileage. Okay, questions for the mayor. Mr. Representative Johnson.
Thank you, Mr. Chair. Thank you for the presentation. I just have, maybe I haven't seen enough of these yet, but question I have, what caught my eye was the line item that a lot of times you see when the tax will be stopped or eliminated. I see here we have the tax will not be terminated before January 1st, 2055. What is the purpose of not allowing it to fade away earlier?
Your Honor.
Thank you, Mr. Chair and Representative. The purpose of this is really conforming to the time period of the debt service on all the bonds to make sure that the stream of revenue, which would be approved by the council, would at least line up for the duration of the bond repayments.
So,
Representative Johnson.
Mr. Chair, so assuming things take off and you get extra revenue, and so you had the ability to pay off the bonds earlier, or is successful, what happens then with the money, I guess, if you get the extra money?
Your Honor.
Thank you, Mr. Chair and Representative. Some of the uses outlined in the bill would again go towards public safety, operation of the district, continue to keeping it up, continuing to reinvest back into that district. Again, as we're looking at 20, 30 years down the line, there will be things that need to be replaced, rejuvenated, and this would allow the district to, again, kind of continue to pay for itself. And if we allow many of the sports tourists, to pay this, I kind of view it as a consumption or a choice tax or fee, then the district really would be able to continue to sustain and pay for itself.
Okay.
Representative Johnson.
Thank you.
Representative Harder.
Thank you, Chair Davids. I just need some clarification. So if you look on 2.13 and be a case, so it says that taxes must be imposed and may be adjusted periodically by the city council. So how is that done? Is that by a resolution? I just need clarification how you do that. Thank you.
Mayor Sanders.
Thank you, Mr. Chair and Representative. It would be through continued resolutions or city ordinance.
Representative Harder.
That's all. Thank you.
Other questions for the author, the mayor, or the finance director? Chair Gomez.
Yeah, thank you. So these are all, I'm just curious about the rate, right? That's 3% on each of these and on each of the different kinds of taxes. It would be, they would match the highest ones in the state. And so I just, wonder if you can tell me a little bit about the necessity for raising that kind of money, especially for a project that looks like it's not a public project, it's a private development, right? So if you could just talk about that. Thank
Mayor
you.
Sanders.
Thank you, Chair Davids, and thank you, Chair Gomez. We're happy to continue to work and seek your advice and guidance on what these limits really are. But at the end of the day, it's kind of a mathematical formula to make sure, in particular, that a lot of the city bonds are repaid due to some of the city infrastructure that the city is participating in. I truly think this is a pattern and a model for what public-private partnerships will look like moving forward. It's a great partnership. And so, from our standpoint, we utilize these numbers to help make sure that, as best we can, the district pays for itself. The city certainly has some financial interest, participate in a lot of the conduit financing as well. So our citizens are certainly, and property taxpayers inside of the city are certainly participants, but we'd really like to make sure that the district and those choosing to lodge or spend their dollars at the amenities there are also helping sustain the district.
Chair Gomez.
Yeah, thank you. So I guess I'm just gonna, we don't know each other, but I'm just gonna confess my bias to you when I hear the terms public-private partnership and I see lots of public money going to benefit a private entity. It kind of gets my, it piques my interest because you used to serve in the legislature, so you know that the things that we do, and I don't know if this is the case in every committee, but certainly in taxes, it's we make decisions that set precedent for the future for decades. We still are looking back at decisions that tax committees made 10 years, 20, 30 years ago, and then we will have people coming and saying, oh, but you did this special thing for these guys, you got to do it for me too. And when that results in, public tax dollars are precious to us, and we have to be good stewards of them, even in the act of allowing our local partners to raise those funds. Just that, I'm very aware of times when people come, especially in front of this committee, with requests for special taxes that expand the scope of the taxes, whether that's in terms of rate or use. And this kind of looks like it does both of those things. And so, I just as we, I appreciate you being here. I appreciate Representative Norris for bringing this forward. But, especially in these cases where, I understand that there are a lot of benefits to the city of Blaine from this, but that the money's going to a private entity and the rules are being kind of expanded, then, we're going to have a lot of conversation if that's the kind of thing that moves forward. Thank you, Mr. Chair.
Thank you, Chair Gomez. Representative Robbins.
Thank you, Mr. Chair. I had a question similar to Representative Harder, but I just wanted to follow up on that. So in that section 2.13 to 2.15, where it says the tax must be imposed and may be adjusted periodically by the city council so that rates imposed produce revenues sufficient to finance the purposes. Is that usual language? I've carried a couple of these bills. I don't recall having that in these kind of bills before. So if you could just talk about why that's necessary, and is it just for the construction and building of the project, or is it for the ongoing future investment? Because they could keep it at 3 and just leave it, or I understand they might start low and go higher, but I would just like to understand how common that is in these bills.
Chair Norris, do you want to hit that, or do you want
Have the mayor
the mayor?
start.
Okay, Your Honor.
Sure, thank you, Chair Davids and Representative Robbins. I guess maybe we could ask House Research how common it is. I don't know exactly how common it is, but I would say, for our purposes, we want to ensure, again, I think one of our principles is trying to help make sure that this district, in a sense, pays for itself. And I think if you look at the volume of sports tourists that come to the state of Minnesota, to the city of Blaine, again, 1,400 acres in the middle of our city are state facilities. And so the city of Blaine is looking to help partner with and provide some very synergistic amenities that help bolster both of those state facilities, but at the same time allowing those users of the district to help pay for not only standing up the project, but continuing to make sure that it's sustained appropriately and remains a desirable district for years and years to come. But as far as how common it is in other tax bills that have been before this committee, maybe I'd defer to House Research on that.
Ms. Hagler?
Mr. Chair and Representative Robbins, so I would have to look back at some of the other authorizing legislation for taxes like this. Kind of as other members of the committee have alluded to, these aren't common, and so each special authorizing law kind of has the ability to customize it to the needs of the locality. So I think a part of the language is to provide flexibility to the city, kind of as you said, where they're able to impose taxes up to 3% if, for example, this was enacted and they started at a 1% food and beverage tax, and a couple years down the road realize that they're not generating enough revenue to satisfy the use of revenues in subdivision 4, then the city council would be able to independently increase that rate up to the 3% allowed by law without having to come back to the legislature for additional approval. And then kind of to the second part of your question, where the use of revenues would go to the bonds for the construction of the amenities, but then also provides ongoing operation, maintenance, and upkeep for those improvements. So kind of as Representative Johnson asked earlier, it's a little bit of a combination of construction plus ongoing until the expiration or the termination that's required in the law.
Representative Robbins. Your Honor.
Thank you, Mr. Chair. Just to perhaps put a finer point on what I was saying, there's a handout, or should be a handout in your pack, that has a map with a blued out shade of kind of where this district is going to be. If you look on the far west, kind of the more vertical portion of that, that's about 20 acres of state land that the city entered into a very long-term lease agreement with the Minnesota Amateur Sports Commission for that property. So it's been undeveloped forever. It is not actually, it's very difficult to develop, very difficult for them to use. The soils are very poor. But we were able to work out in great partnership a really good, lease agreement, long-term lease agreement for that property and that land as well. So again, a lot of this is bringing something out of nothing. And due to, again, just the volume of acreage that the state owns in the middle of our city, being able to put something there that not only will truly benefit the state, the state of Minnesota, but also the city of Blaine, and I think a great synergistic partnership.
Mayor, were you referring to, on the west side, the light shaded area?
Yes, Mr. Chair. If you can see, actually, this entire chunk right here
Yeah,
is all state property,
Oh, okay.
state land.
I was going a little further west, sorry.
Yeah. Those are now turfed fields. Part of that lease agreement is the city funds went to help establish 12 additional turf fields at the National Sports Center, which makes it actually, I think, acreage-wise, I think the largest turfed fields in the country, which again lines up with the largest ice facility in the country, and truly, it's an amazing facility, and what it does for this state and certainly for our city is truly great. I will put in a plug for them. They have a lot of deferred maintenance over there and really need some long-term funding solutions, some creativity. But it truly is a state asset. It truly does make Minnesota a very special place.
Representative Whitty.
Thank you, Chair Davids. Thank you, Mayor, and Rep. Norris for bringing this bill forward. As former president of Minnesota Thunder Academy, I do know the importance of that state asset and what it does, not just worldwide, but throughout the country and throughout Minnesota. And I know there's an overflow that goes throughout the Twin Cities. And one of the things I will say is we've traveled our teams throughout the country to world-class facilities, and a lot of times the drives can be up to an hour to get to the fields. Having some more stuff around there, the economic boost that it gives, not only to Blaine, but throughout the Twin Cities. So obviously, I'm encouraged to see you trying to improve that area because it does represent Minnesota well. So thank you.
Thank you, Mr. Chair.
Thank you. And I was looking on page 3. We may have to review this, 2055. I should still be here. Okay, Representative Lee.
I have no doubt, Mr. Chair.
Representative Lee.
Thank you, Chair. I guess this is a question for the mayor. We often see cities come to this committee with a variety of proposals to help them raise revenues. I guess it's a two-part question of, what happens if this doesn't pass this year? Like, what are other tools in the toolbox that the city has thought about? Because from what I understand, this is a very unique ask. And so if it's not this, like, what else could it be?
Your Honor.
Thank you, Mr. Chair, and thank you, Representative, and happy to have Director Zimmerman drill down after I take a shot at it here. But I think, going back to my statement earlier where I said, I think this is, truly a model for how we bring, probably what will end up being $1 billion development to life here in short order. I think we've already used a lot of creativity around this. There's many different I would call buckets of funding sources that we're using. One of them is for the first time in the city of Blaine and Anoka County. We're using tax abatement. The school district, the county believe in this project so much as well. They entered into a tax abatement agreement with us. So there's a lot of different things that we are doing. The city itself, we have an economic development authority, so we'll be participating through that as well. But there's a whole host of revenue streams, and from our perspective, this wouldn't even cover all of it, but it certainly would allow us to help. And again, for me, just the principle of letting those that choose to participate in the district and want to use the district stay in those hotels really help pay for the district, at least in some part.
Representative Lee. Or Mr. Zimmerman.
Mr. Chair and Representative, the mayor's provided a good synopsis of kind of the history to lead into where we're at today with the utilization of many mechanisms that we had at our disposal to help finance and facilitate this project. And to the mayor's point that this is really the intent here and from the elected body to establish a geographic bounds of the district to coincide with where the improvements are located and not to necessarily implement or request to impose a citywide sales tax, which is conventionally requested to facilitate various improvements in a community. So really where we're at today is the request before the committee to move the bill forward. But ultimately, the property tax levy theoretically is the ultimate quote unquote backstop to help finance and facilitate the project.
Representative Lee?
Yeah, thank you, Chair. And I know, many of us are hopeful for maybe passing a tax bill this year, but, even if this is like a good idea, right, like this might not pass. And so that was going to be my question, whether, this would mean the city would have to resort to increasing property taxes or just, if it means that you're braiding multiple streams of funding, is it then asking more from corporate partners for this project?
Your Honor.
Thank you, Mr. Chair and Representative. Again, Director Zimmerman can correct me if I'm wrong on this. There are a lot of corporate partners and will be corporate sponsorships and naming rights and all sorts of things that are in those larger revenue buckets that I was discussing earlier. As far as the public-private partnership, I think the city is maybe about roughly 8 to 10%, and the private developer is funding the other 90%. So it truly is a development where the city is certainly a partner, and we're doing things that I really think government should be doing. A lot of the infrastructure, the roads. Obviously, we need a lot of parking, not only to facilitate what's happening, in our district, but what's happening at the National Sports Center and on the Mask property. So there's a lot of ways that we are participating, but they are bringing significant dollars to the table to stand this up.
Representative Lee?
Good, thank you.
I have one person left on there, one member left on the list, Representative Johnson.
Thank you, Chair, and thank you, Mayor. One of the things was Representative Whitty started talking, and it's like there's a fellow girls soccer dad that has spent a lot of hours up in Blaine. We were on the same team. Our daughters were on the same team and spent many. And I would just like to say one of the coolest things up there is it's actually a great cultural exchange for these daughters, because my daughter has pictures and met people from Europe and Norway and stuff like that, and for them to come over here and see what we're about and the players, both girls and boys, doing it. So it's actually a very educational experience that happens every year. So it's really cool to see that. I just had one question. What is the term on the lease with the state then for that land?
Your Honor.
Thank you, Mr. Chair and Representative. Director Zimmerman, correct me if I'm wrong. Mr. Carlson's here as well. That can help me make sure I'm accurate here. I believe they are 30-year leases with 3 additional extensions, so up to 90 years.
Okay.
I believe.
Mr.
It's been a while since I've looked at that.
Mr. Zimmerman, is the mayor wrong?
Mr. Chair, Representative, no,
Careful how you
the
answer
mayor is correct.
Yeah, be careful. Yeah, okay. Representative Johnson.
Thank you, Chair.
We need to get some terminology correct around here when it comes to soccer. You always hear of soccer moms or soccer dads. That's not really what it is. It's really soccer grandpas.
Yes.
That's what it really is. Okay, so let's get that straight. Okay, any other questions for the author, the mayor, or the finance director? If not, Representative Smith?
No, I was just looking at you.
Oh, okay.
Adoring you.
You have to get a life.
I'm just paying attention.
My neighbor to the north. Okay. If you'd like to wrap up, Chair Norris.
Yeah, thank you, Chair Davids, and thanks for giving this bill a hearing. As Representative Johnson was pointing out, this really is a facility that brings the world together. I know I don't have kids in soccer, but one of my favorite things to do during the USA Cup is when I'm out doing my regular shopping at Target. You'll see teams from Iceland and Jamaica and everybody around the world coming to Minnesota, to Blaine specifically. And so I do think that there's a lot of value in making sure that we've got the amenities around this facility to continue having it be a strong state asset. And I think this is the beginning of what will be a conversation about how to, shape this appropriately, but I appreciate the opportunity, Chair Davids, to start that conversation today, and looking forward to continuing to talk with my fellow members of the committee about this moving forward.
And thank you, Representative Norris, and the Mayor, Finance Director, thanks so much for being here.
Thank you.
Chair Gomez, about tomorrow.
Tomorrow, we're going to be talking tax expenditures. Be there or be square.
All right, anything else for the good of the order? I'd like to thank House Research, Fiscal, for your help today. Very informative, and you're not done with this yet. We're going to be talking about these things a lot more. Thank you.
Usually you do that to me, so turnabout's fair play.
The bill is laid over for possible inclusion in the omnibus tax bill that will be passed probably in May. Okay, so with that, good government all the time, we're adjourned.